In our second lecture related to long-lived assets, we're going to focus on additional testing. Some of this additional testing is in the planning phase, and then we're going to focus on test of controls as well as our substantive testing. One of the things that becomes very important as we gain an understanding of these accounts, as well as determine what type of substantive procedures we're going to do, is to understand how we might be able to use ratio and trend analysis in the analysis of long-term assets. In this case, what we're going to look at is we're going to review and analyze any gains and losses on disposal, identify the performance overall, or perform an overall estimate of depreciation, and we're going to compare this to prior periods. We're also going to compare the capital expenditure with the budget. We're going to compare depreciable lives for various assets in various categories, as well as compare the assets and related expenses based upon similar items in prior periods. In the planning stage, and keep in mind in the planning stage, we are in this stage where we are attempting to determine the risk of material misstatement. What we're doing is we are looking at ratio analysis from the perspective of directing our attention to specific risk areas. So things like the ratio of depreciation expense to total depreciation, depreciable long-lived assets. If we do this comparison from year to year, theoretically, if assets are being brought on in a routine basis, that percentage is really not going to change from year to year. The ratio of repair and maintenance expense to total depreciable assets, well, this will in one way determine if in fact maybe we have many old assets that are requiring additional maintenance and repair. This also may be a key in terms of determining whether or not the organization is inappropriately capitalizing repair expenses. We also want to consider the long-lived assets to total assets. Again, this is an item that probably should not change significantly from year to year, assuming that there's no major additions or subtractions. And if there are, well, then certainly that's going to explain what's taking place, but the ratio itself will direct our attention in terms of these types of changes. Ratios should involve the comparison of the unaudited financial statement information with past results. We're also considering this related to industry trends, and we're also considering the auditor's expectation. This is one of the reasons why the auditor needs to have a good understanding of the industry, because when the auditor understands the industry, he or she is going to be able to use this experience to develop expectations and to identify specific risk areas. When we're using analytical procedures as planning procedures, now keep in mind that analytical procedures as planning procedures is a required step. But if we're using these analytical procedures and we find no unexpected relationships, then the auditor is going to conclude that there's no heightened risk related to any specific area, and the auditor will then continue his or her testing as planned. If there are unusual relationships based upon these planning analytical procedures, what the auditor is going to do is to adjust his or her testing to address these potential misstatements. Now keep in mind that many of these unexpected relationships can be explained, but that's not the point. The point is that what these procedures do is it directs our attention to what is different as compared to last year and helps us understand how we're going to complete our testing. So what we're doing through this process is understanding the risk of material misstatement. So as we've talked about the risk of material misstatement, what we're really attempting to do with this information is to determine the nature, timing, and extent of additional procedures. If they're substantive procedures, we're using these procedures to measure monetary misstatement. These substantive procedures is what are used to determine the fair presentation of the financial statements. As test of controls, what we may be doing is, if this is part of a Sarbanes-Oxley testing for the internal controls over financial reporting as part of an integrated audit, we're going to continue the testing as test of controls. The other thing to keep in mind is the decision in terms of the reliance on substantive testing or the reliance based that is going to be placed on the control testing. This is the variable that the auditor is going to determine as the audit progresses. If the client's controls are relied upon, then the auditor can primarily rely on substantive analytical procedures. Again, back to the phrase that we've used over and over again, is the risk of material misstatement will determine the nature, the timing, and the extent of our substantive procedures. So the nature of testing is going to be more geared towards analytical procedures if in fact the control risk is low. Auditors should customize their standardized audit programs based upon the assessment of the risk of material misstatement and client-specific conditions. Again, as we are conducting the audit, it's very important for us to determine any risks based upon our understanding of the client and the environment where the client works. When we're considering specific client issues, again, what we're looking at here is we're looking at the risk of material misstatement. So these are the things that the auditor needs to consider as the determination is what type of testing the auditor needs to continue. So the idea is we have two contrasting situations. Organizations that have only a few assets, but these are of relatively high value. What we're going to use is a substantive approach using the test of details for obtaining evidence. We're not so much interested in terms of determining the test of controls. If the organization has a high volume of long-lived asset transactions, as an example, I worked for an organization that we had well over 10,000 separate pieces of equipment. Well, this is a lot of equipment and has unique situations in terms of a control perspective. So what we would be interested in is performing test of controls to support a moderate or low assessment of the internal control risk, and then possibly reduce the amount of substantive testing. Again, you notice how the control risk and substantive testing sort of work together in terms of mediating controls as well as determining what we need to do to measure monetary misstatement. So we have an example here related to performance of the test of controls. Assume that the client implements a policy requiring the establishment and enforcement of property management training. So this is the control. Everyone has to go through property management training. So from this perspective, what are we going to do to test this? Well, this actually is a very good example of a specific control. So what we're going to do initially is this process of inquiry and observation. We're going to make inquiries as to who's completed the training, what the nature of the training is. We're going to observe management's action in process as it relates to our understanding of the training. Now you notice the last piece is the inspection of the documents. So in a sample process, what we're going to look at is we're going to determine, based upon an attribute perspective, is there support documenting the actual property management training in personnel files or wherever this information is actually retained. The outcome of the test of controls is going to determine our substantive testing procedure. As we're conducting our test of controls, if control deficiencies are identified, we're going to assess those deficiencies to determine the severity. We're going to modify our preliminary control risk assessment and obviously document the implications of the control as it relates to our substantive procedures. If there are no control deficiencies identified, we're going to determine whether our preliminary assessment is correct, determine the extent to which control testing can provide substantive evidence, and then from there determine the plan level of our substantive procedures. So again, when we're talking about substantive procedures, we are using these procedures to measure monetary misstatements. Long-lived assets reflect a balance sheet account. Okay, so what we're looking at here is we're looking at existence. The next point is we want to test the rights or the ownership of these assets. So rights is another management assertions. Long-lived assets should include all relevant items, including those that are purchased, contributed, constructed in-house or by third parties. So we're looking for completeness in this perspective. Long-lived assets are recorded correctly. We're looking for accuracy, and items to be capitalized are identified and distinguished from repairs and maintenance expense items. This is a big deal, and this is really related to classification. So drawing that line between what items are repair and maintenance, that essentially are period expenses, and those items that are capitalized, that essentially stay on the balance sheet and are only depreciated, is a key consideration when we're considering the issue related to classification. Depreciation, amortization, and depletion calculations, we need to compare these to make sure that these are based upon appropriate assumptions, useful life and methods. Retirements, trade-ins, any unused property and equipment are identified and reported correctly. Long-lived assets, we need to determine that they are appropriately presented with adequate disclosures. We also need to determine whether or not there are any fraudulent transactions associated with these long-lived assets that are reported or not reported in the financial statements. As we've talked about, analytical procedures helps us gain a good understanding of this process. We're using analytical procedures as part of our assessment process, but we also can use substantive procedures or analytical procedures as substantive procedures. When we're using analytical procedures as substantive procedures, what we're using or what we're doing is we are attempting to determine if in fact there are material misstatements, and we're doing this based upon this ratio analysis. So some of the things that we might be able to do is to determine the reasonableness of the depreciation expense and the associated accumulation depreciation based upon some various parameters that we have. There certainly are going to be a number of relevant ratios. We've actually talked about a few of these. And again, what we're attempting to do is we're attempting to determine the reasonableness in terms of the estimates that management makes related to depreciation and accumulated depreciation, and essentially the reported value of these assets in the balance sheet. Substantive testing of tested details for tangible assets. We're testing for current period additions. We certainly also want to consider current period subtractions. Again, long-lived assets are on the books for a long time. So once we've determined and established a baseline, what we're really interested in the subsequent years is taking a close look at additions and subtractions. So what we're looking for is we're taking a look at these additions and subtractions. We're agreeing these to the general ledger. We're going to take a sample of these items for testing. We may do physical testing to determine if in fact these items exist. We also, let's say that this is a capitalized project, is take a look at that project and see if the items have been appropriately allocated between expenses, maintenance, as well as capitalized items. So the auditor needs to determine that capitalized additions are appropriate and that none of these should have been expensed as repair, maintenance, or other period cost. And many times what this takes is it actually takes a physical examination of what's actually taking place. When we're looking for period deletions, we need to trace the original cost of the item and its accumulated depreciation, make sure that has been removed appropriately from the financial statements, recompute any gains and losses to determine if it's been accounted for appropriately, and then perform any searches for any unrecorded disposals. We want to also consider the procedures for depreciation expense, accumulated depreciation, as for tangible assets. The objective for testing depreciation is to determine whether the client is following a consistent depreciation policy. Unless the policy, if the client has a justification for changing the methods, we need to understand this. We need to determine the calculations. We need to, again, looking for these from the perspective of reasonableness. If the audit risk is low, the auditor may primarily rely on substantive analytical procedures, which again, you kind of think about depreciation expense. Once you've established the cost and the depreciation method going forward, assuming there's been no changes, then the calculation for depreciation expense is pretty straightforward. So many times that's really all we need to do is to recalculate and make sure that it is reported appropriately. So when we're considering depreciation and accumulated depreciation, we're starting with the long-lived asset ledger. We foot the long-lived asset ledger to match it to the general ledger, identify all entries into the depreciation and accumulated depreciation. We want to consider the asset disposal in this process, and then we're going to sample some items to recalculate the depreciation and to then from here extrapolate our results to the entire population. Natural resources has some unique features. From a natural resource perspective, what we want to consider is the client's process in documenting the costs related to exploration and drilling. We need to substantiate the amounts of these resources that have been sold during the year. We also will probably use an auditor specialist or an expert to perform additional analysis in terms of possibly valuation to review the client's analyses. Again, we as auditors need to be skilled in auditing, but there's very specific things that we don't necessarily have the skill set for. So it certainly is appropriate to bring in a specialist specifically related to this process. When we're looking at intangible assets, we have many of the same types of issues. We need to review the documentation, inspect it, and we want to test management's calculations of any gains and losses. What we would expect is that management has a very good documentation system specifically related to intangible assets, especially as these intangible assets move from an expense perspective related to our research and development to the point where they've actually been determined to be capitalized. So we need to determine whether amortized expenses is accurate. We need to determine the calculation. We need to inquire of management where circumstances indicate that the carrying value may not be recoverable. One of the things that management needs to be doing is documenting their decisions. When we consider asset impairment, the auditor needs reasonable assurance that long-lived assets are valued at the economic value to the organization. So it's beyond just costs minus accumulated depreciation. If there is an impairment, management needs to write this impairment down in the asset and have a corresponding expense. We need to understand the process of assessing the impairment and evaluate the reasonableness of management assumptions. Again, management needs to be documenting this. It's probably recommended that management writes a very short narrative in terms of the impairment process, includes some calculations, and possibly have it signed off by the CFO and the controller. In any event, the idea is that as auditors, as we come back and review this information, we need to understand that management has in fact gone through a very objective process in determining the appropriate write-down. Leases have specific issues. When we talk about leases, we need to determine what leases are capitalized, what are operating leases. To do this, we need to obtain copies of lease agreements, read these agreements, develop a schedule for expenditures. We need to review the lease account, select entries, and determine if these entries are appropriate based upon the client's documentation, determine whether or not the related FASB standards specifically for leases are met based upon the requirement for capitalized leases. For capitalized leases, determine the asset and lease obligation at their present value. We clearly need to have an understanding of what discount rate management used in their calculation. We need to develop a schedule of future lease obligations or determine whether the client schedule is correct. And again, we're talking about a simple amortization schedule. As long as we understand the useful life and the discount rate, it's going to be very easy to do that calculation. That's going to be part of our permanent documentation. Review client's disclosures of lease obligations to determine that it is in accordance with GAAP. Fraud is an issue that we need to contend with, and we're going to contend with this based upon very specific substantive procedures. We want a physical inspection of tangible assets and agree the serial number with supporting documentation. We need to understand how the organization is tracking these tangible assets. Request client to perform a complete inventory of long-lived assets, scrutinize the appraisal and other specialist report that seem out of line with reasonable expectations. We clearly have an option of using a specialist for asset valuation, especially when it comes to impairment. And again, this is going to be industry specific, and this is why the auditor really needs to have a good understanding of the industry. When vouching long-lived asset additions, accept only original invoices, purchase orders, receiving reports, or other supporting documentation, confirm terms of significant additions with other parties involved. For tangible assets, we want to summarize the beginning balance, additions and deletions, ending balances. And again, as we're considering our tangible assets, we're focusing on additions and subtractions during this period because this essentially is an ongoing process. These long-lived assets are going to be around for a number of years, and we don't necessarily have to be retesting every asset once we've established a baseline for it. Okay, so this is a good review of the additional testing that we're going to be doing. This additional testing, as we've talked about, includes analytical procedures, both at the planning stage as well as our substantive testing. We also considered test of controls, gave some specific examples related to this, and our substantive procedures. So I thank you very much for your time, and I'm looking forward to talking to you again. Thank you.